So let me take this opportunity to welcome you to our week 2. I think this should be week 1 of February. We are still doing the techniques of measuring risk. Today, we just want to finalize on the question regarding to sensitivity analysis. But I have a small illustration here before we go back to past paper. We have an illustration there, which I just want us to look at. So we are being told here, that Unga Limited is considering undertaking a project with the following cash flows. Is considering undertaking a project with the following cash flows. We have our number of years. We have years here, right? We have the cost of land, Kenya shillings in thousands. Then we have running costs. Our running costs, Kenya shillings in thousands. We also have the savings. Our savings also in thousands of shillings. We put them there. So we are going to be having year 0, 1, and 2. So year 0, we have cash flows of 10,000 or initial outlay of 10,000. Then year 1, we have 4,000 running costs. Year 2, we have 5,000. Then we have the savings of 12,000 in year 1. And also we have 14,000 for year 2. For year 2 there. Requirement, we have been told the minimum required rate of return. The minimum required rate of return. The minimum required rate of return from the investments. Is 9%. The minimum required rate from the investment is 9%. Required number 1. Required here, number 1. Required here, we are being told, number 1, we determine, this is the requirement number 1, determine the sensitivity of the project. We determine the sensitivity of the projects. We determine the sensitivity of the projects to changes in the levels, of the cost of the plant, right? Running costs and savings. We are being told here in brackets, considering each factor at a time. Considering each factor at time, right? We consider all that and assuming each factor. We assume each factor is varied adversely. Varied adversely by 10%. Is doing all that. So there is one thing that I just want you to understand here. there is a small concept that I just want you to understand, that when you are doing the sensitivity analysis, and we have the aspects of the adverse. There is this proportion an examiner is giving you here, right? It's telling you to adverse by 10%. So if you are dealing with the costs, right? If we are dealing with the costs, it means you just need to increase. You increase the proportion. So if it was 10%, it means you increase it to 110%. But if you are dealing with the revenue, you reduce the proportion or the percentage. You reduce the proportion here. So I just want us to start by looking on the first one, right? Let us look on the first aspect here, whereby we are being told we determine the sensitivity of the project to changes in the level of the cost of the plant, running cost, and the savings when we consider each factor at a time. So I just want to start with A here. We say if the cost of the plant, let me start with A here, based on the analysis. We say if the cost of the plant, adversely by 10%, it advances by 10%, right? So in this case, remember we are starting with the cost of the plant, which is a cost. And in this case, we say the cost of the plant will increase from 10%. The cost of the plant should increase from 10%, from 10,000, right? To what? You say, let me take 10%, because I'm varying it adversely by 10%. And we have said, when you are advancing the costs, you increase the proportion. So in this case, I have increased mine to 110% of 10,000. Right? Of 10,000. And in this case, it means you're going to be getting how much? You're going to be getting 11,000 Kenyan shillings. 11,000 Kenyan shillings. After you do that, it is very important for you to calculate the NPV of this project. The NPV. Am I going to be getting the NPV? Am I going to be getting the NPV of all this? It's very simple. Because to get the NPV, it means that we have to be factoring the running cost, the savings, and so on. First, to get the actual NPV of the project, so that we can look on the percentage change, right? I just want you to look on the percentage change. So in this case, let me start by looking at the aspects of computing the NPV in our scenario here. So let us take the number of years. You have year 0, you have year 1, you have year 2, correct? So when you look on the cost of the plants, let me start with the cost of plants. Our cost of the plant will be 10,000 at year 0. It will not apply in year 1 and year 2. But when you look on we have some running costs here. Let us look on the running costs. The running costs are not available in year 0, but they are available in year 1, 4,000 here. And they are also applicable in year 2 at 5,000. Remember, these are the costs, right? And we need to get the present value of we need to get our net cash flows. Then we take our revenue, which is our savings. So once we take the savings are only applicable at year 1. Here we have 12,000. And here we have 14,000. And we said, when we have our savings, that is our revenue. When you have the savings, they form part of your revenue, right? They form part of your revenue. Yeah. In this case, after you do that, you can be able to subtract, or you can be able to take the summations down here. So the first one here, we still have 10,000 at year 0. Here we remain, when you do the subtractions, you remain with 8,000. And here you can see we have 9,000, right? These are your net cash flows. Those are your net cash flows, right? Now, after you get your net cash flows, it is very important for us to compute the NPV. And this NPV of ours, we just need to discount it. So am I going to be discounting my NPV? I say, let me take my years, right? We have cash flows. We have our cash flows. We have our discount factor. We said we are going to be discounting at a minimum rate of return at 9%. Then we get our present value. We get our present value, something looking like that. Don't mind about my space. Right? It looks like that. So we have here 0, right? The cash flow is 10,000, which is our initial outlay, right? This, the discount factor remains 1. Then here we have 10,000, which is negative. We go to year 1, right? And when you look on these cash flows of ours, let me change this camera so that you can be able to see everything. Let me tune it a bit. Okay. People can be able to see everything, yes. So in this case, we say when you have the cash flows which are not similar, this is irregular cash flows. And when you look on the irregular cash flows, it means we are going to be using a formula for lump sum. Correct. So if these cash flows of ours are irregular, you're going to be using a formula of lump sum. So in this case, for example, the first year we have 8,000, and then year 2, we have 9,000 shillings. We have 9,000 shillings. So the formula for lump sum, we said, what are we going to be using? We say the formula is 1 plus r, we raise power negative n. 1 plus r, we raise power negative n. I would like someone like Cecilia to give me, for the first year, what will be the discount factor here? What will be the discount factor by taking 1 plus 0.09, you raise power negative 1? What will be the answer? Then Esther can do the second one. How much is the first one? Zero points. Cecilia? Once you do all this, how much are you getting?
0.917.
0.9174. Always deal with the 4 decimal places. Esther, the second one?
0.84167.
0.841. Is it 167?
Yes, 168.
Let us deal with the 0.8417. Once you take your cash flows, you multiply by the discount factor. How much are you getting? Meshach? How much are you getting the first one, please? Very quickly. Then inside here, you don't
7.
The second one is how much? Someone is speaking. So how much is our present value of the cash inflows? The present value of the cash inflows is how much? The present value of the cash inflows is how much? After you take your summation, how much are you getting? Is it the present value of the cash inflow? No. It should be our NPV. Our NPV is how much?
14,000.
14,000.
914.5.
914.5. 914.5. Correct. 14,900 and something. Is it 14,000? No.
Yes.
Hajatoa 10,000. It should be 4914.5. 4914.5. Are we getting something like that?
Yes.
Very good. So remember now, this is our initial NPV. And you remember the computation of the sensitivity ratio. We said the first thing that you have to be getting is you get the NPV of the project. That is what we said. And we have already gotten it. It's 49.14. So once you advance, what is going to be changing? For example, we have said if the cost of the plan will be able to advance by 10%, what will be the new NPV? So to get to a new NPV here is very simple. You say, to get my new NPV, what has changed is the cost of the plans by from 10 to 11,000. But the other factor remain constant. So what am I supposed to be doing? I just need to take 7339.2 plus 7575.3 minus 11,000. How much are you getting? I hope you have understood here. We are getting our new NPV. We have changed the cost of the plans from 10 by advancing it by 10%. So from 10,000, once you advance by 10, you get 11,000. So what is your new NPV? What is your new NPV?
4,814.
There must be someone who is asking a question. I don't know. Say, Louis, I'm not in the camera. Now you can be able to see it. Can you be able to see it? You can unmute and talk to us. Someone has told me they are getting something closer to 39.14. Is it something like that?
38.
39.13.5. 39.13.5. 39.13.5. Everyone is getting 39.13? Is everyone getting that?
Nenda. Mbona mapema hivi?
Someone is talking. So to get the percentage change, there is something I said here. To get your percentage change, there is something I said. There is like a formula we are using to get the percentage change. There is like a formula we are using to get the percentage change. We said we are going to be taking the old minus new. You divide by the old, you multiply by the 100%. There is something we talked about this. Old minus new, you divide by the old, you multiply by 100%. And these are NPVs. These are NPVs. So the first one will be what? I just say, let us get the old. The old is 49.14.5 minus, you have told me it's 39.13. You will bear with my space of my board, 49.14.5. Then you multiply by the 100%. What is the percentage change here? What is the percentage change there? What is the percentage change? Someone? Someone? What is the percentage change? And what is the analysis? That is what I just want to write here. Correct. What is the percentage change? Someone to show the answer, please.
20.35%.
Thank you so much. It should be 23%.
36.
Something like that. 20.3%. So what is the analysis of your answer? You can say the 10%. Let me write here an analysis. And we say 10% adverse change. The 10% adverse change in the cost of the plans. In the cost of the plans, the 10% adverse change in the cost of the plans, right? Other variables remaining constant. Other variables remaining constant. Other variable remaining constant has resulted in 20.3%. 20.3% adverse change. 20.3% adverse change in the value in the value of NPV. In the value of NPV, right? Then you'd say, therefore, just say therefore, this is a sensitive decision variable. This is a sensitive decision variable. You have said the 10% adverse change in the cost of the plant when the other variables remain constant has resulted in 20.3% adverse change in the value of NPV. Therefore, this is a sensitive decision variable. This is a sensitive decision variable. As you continue writing, because I know you are writing, let us look on the next variable. We say, let us calculate the sensitivity analysis. Right? We look on the sensitivity analysis on running costs. On the running cost. Don't forget about our initial NPV. You know our initial NPV is 4914.5. 4914.5, right? So let us look on the sensitivity analysis on the running cost. And we have said, when you are dealing with the costs, what are we going to do? We are going to increase the proportion when you are dealing with the cost. So in this case, you see the running costs are 4,000 and 5,000. When you are dividing them by 10%, how much are you getting? When you are dividing them by 10%, how much are you getting? How much are you getting now? So let us calculate our NPV in that manner. So let me look at it here. Let us compute about our new NPV here. Right? Our new NPV. When the running costs are adverse by 10%, and they are adverse by 10%. So to calculate your NPV, because we have all the data here, what is very important is looking on the analysis. And I just want to do it in this manner. We have years. We have year 0, 1, and 2. We have the cost. Let me just use the short forms. The cost of the plant, which is 10,000 here. It is not applying in year 1 and year 2. Then we have these running costs. Our running cost is how much? Our running cost is 4,000. When you advance 4,000, by 110%, you just take 110%, you multiply it by 4,000. And I know very well that you are getting 4,400. It is not applicable in year 0, but it is here, 4,400. Then it means if I multiply 110% by 5,000, I'm going to be getting 5,500. But the other factors remain constant. It means our savings remain the same, right? So here it will be 12,000, and there should be 14,000. 14,000. How much are you getting there? How much are you getting down there? I know the first one is 10,000 negative, right? 12,000 minus 4,400. You're getting 7,600. Then we have 14,000 minus 5,500, getting 85. 5,500, right? 5,500. After you do all these, let us discount. You say, let us multiply by the present value interest factor. This is what we normally do. The present value interest factor, it means the cash flows are not the same. This is the short form of how we normally write the formula that we have used to discount our cash flows. So in this case, the rates, right? Our rate is 9%. Then here I can write 10 years. Because we are using different number of years, So the formula still remains the same. It is 1 plus r we raise power negative n. 1 plus r we raise power negative n. So the first one will be 1.09, because it is 1 plus rate, we raise power negative 1. This remains at 1. So this will be the same, 0.979174. Then the other one will be how much? Remember, we have these answers. 0.8417. 8417, right? Now, let us get our NPV here. Let us calculate our NPV. And our NPV will be, the first one will be negative 10,000 plus what? If you take 7,600 times 0.9174, you're getting 6972.24 plus, the other one will be 8,500 times 0.8417, getting 7154.45. How much are you getting here? Is your new NPV. By the way, should be the new NPV. So how much is your new NPV? Faith? How much? I'm getting 4126.69. 4126.69. 4126.69. So let us look on the percentage change. How much is your percentage change here? What is your percentage change? Someone to shout the answer? Because we take the olds, which is 49 watts. What is our initial NPV? Ilikuwa 49 watts.
4914.5.
Correct. 4914.5 minus 4126.5.69. You divide it by 4914.5, then you multiply by 100%. How much it is? 4914.5 minus my answer. You divide it by 4914.5. Someone is getting 16.03? 16.03? You can confirm my answer and you tell me whether that is what you're getting.
Yes.
Correct. So once you get the percentage adverse in NPV, you say, this is a decision, this is a sensitive. Is a sensitive decision variable. It is a sensitive decision variable. It's a sensitive decision variable because a small percentage. Because a small percentage change in the value. The percentage change in the value of this variable. Has resulted in a bigger percentage change. In a bigger percentage change. Percentage change in the net present value of the project. Mimi najua hata ya mwisho mnaweza fanya. Najua vizuri sana. Now we are dealing with the savings now. Right? We are dealing with the savings. Right now. The sensitivity analysis on savings. Sensitivity analysis of the savings. I know you're writing. Najua Faith is disturbed by the network. So let us look on the percentage change. The percentage change in savings. Right? Sensitivity analysis on savings, which is our C. Okay. Now, if you're analyzing the savings using the same question, if you're analyzing the sensitivity analysis in savings, this is what you're supposed to be doing here. Now, we have here 0, 1, and 2. Correct. So we start with our costs. Our cost is 10,000 at year 0. Correct. Then it is not applying, the cost is not applying year 1 and year 2. The running cost now, they are constants, right? Or they are not changing. So here we have 4,000, and there we have 5,000, correct? But our savings now are going to be reduced. Rather than doing at 110, because we were doing at 110, right now we are doing at how much? We are doing at 90. So we are doing at 90% of 12,000. Think here now it should be 10,800, right? 10,800. Then the other one will be 90 or 14 of 14,000. 90% of 14,000 is how much? 12,600.
600.
Thank you so much. Now, what is your cash flows? So the first one is 10,000, which is negative. The other one will be 10,800 minus 4,000. We are getting 6,800. Then the other one will be around 76. Will be 7,600, right? Now, what are the present value interest factors at 9% N years? The first one was how much? This is 1. This is 0.2. 0.9174. Then the other one is how much? 0.8417. 8417. So what is our new NPV? What is our new NPV? So the first one will be negative 10,000 plus what? 6,800 times 0.9174, getting 6238. 6238.32 plus what? 7,600 times 0.8417, 6396.92. What is your total NPV? Right. You're getting 2635.24. 2635.24. So let us look on the percentage change. Right. So what is our old? We said it is 4914.5 minus 2635.24. You divide it by what? You divide it by 4914.5. Then you multiply by 100%. Multiply by 100%. So how much are you getting here? How much are you getting quickly? Someone?
46.4.
Correct. 46.4%. And you can say the percentage adverse has resulted in a very sensitive decision variable in our savings. And that is what you need to be doing when you are doing the sensitivity analysis question. I have only one question before I get out of this. There is a question they tested on, I think it should be December somewhere. So let me share, unless there is someone who is writing. I can wait. So someone to read the question for us, please. December 2022. We are discussing question number 1B. Can Celia do that for us, please?
Okay, sir. The management of College Publishers Limited has estimated the following initial cash outlay and the net cash flow and probability for the new printing process in each case scenario.
Continue.
is the worst, most probable case. Then the best
Seluya
case,
anapotea.
the year starts from 0
Seluya
to
anapotea. The management of college publishers limited has estimated the following initial cash outlays and the net cash outflows and probabilities for the new printing process in each case scenario. So I can see we are being given the worst case, the most probable case, and then we have the best case scenarios. Naona pale amekuwekea year 5 zikiwa mbili. Naona kuna moja wamekuwekea ka star pale, right? That one means is the terminal cash flow. That is a terminal cash flow provided there. And the terminal is always recognized. So it's going to be ascertained. We are going to be ascertaining that revenue only once at the end of year 5. Now, year 0 is the initial cost of the new printing process. Year 1 to 5 are the operating net cash flows, and the year 5 is the estimated salvage value. So the firm's cost of capital for the projects of average risk is 13%. We are being asked in the requirements, very simple things here. We assume that the above project has an average risk. Compute the expected net present value, right? The expected NPV of the project. Then number 2, we are being told to come up with a sensitivity analysis of the salvage value. If this variable changes from the base case value by plus minus or the plus minus 80%. Number 3, we are being assuming that all the cash flows are positive, perfectly correlated, and that there are only 3 possible cash flow scenarios over time. Namely, we have the worst case, most probable case, and the best case with the probabilities of 0.2, 0.6, 0.2 respectively, right? Now, when you look on the questions provided here, it is easy for us to be able to do it bit by bit. We are going to be starting with the requirement number 1. We are being told that we have to be assuming that the above project has the average risk, computed the NPV expected. Now, I just wanted to look at the aspect of computing these NPVs, and we will be able to start with with all of them. But I will be kicking off with the first one, right? So the first one will be the worst case scenario. The worst case scenario. Now I'm answering Seluya's question regarding to when to use the annuities and when to use the lump sum. You can be able to look on the cash flows which are already provided in the questions and see whether the cash flows are similar and where do we have to be using the PFIFA and where do we have to be using PFIF. Now, let us start with the worst case scenario. Worst case, right? So when you start with the worst case, we are being told from year 1 to year 5, we are going to be getting the initial, not the initial, but the cash flows of 20,000. So because it will be 20,000, we multiply by the present value interest factor annuity, right? Why? Because from year 1 to year 5, we are going to be getting 20,000. We use PFIFA, 13%, 5 years, plus what? The terminal cash flow, which is going to be, which is expected at year 5, amounting to 5,000 for worst case scenario. We multiply now with PFIF, 13%, 5 years. Minus our initial outlay. How much is our initial outlay here? The initial outlay for each case is 100,000. What is your NPV at the ends? So in this case, it is very simple by breaking it down by doing this. Now, this one, the formula applicable here is 1 minus 1 plus R we raise to N, we divide by R.
Repeat.
Sorry?
Repeat. I'm not getting it.
I have said 20,000
Yes.
are cash flows which are going to be generated from year 1 to year 5. We are using PFIFA. From year 1 to year 5, you can see the cash flows are similar. They are regular. That is the simplest term to use. They are regular cash flows. When we have regular cash flows, we normally use annuities. When we have irregular cash flows, we normally use lump sum. We don't have A here, right? So the formula to get the lump sum here, ndio hii hapa. 1 plus r we raise for negative n. Right? That is why you are not seeing us taking 20,000, we multiply it by P5 because it has an annuity aspect, right? It is annuity in nature. So how? What is the answer for this P5? What is the answer for this? What is the answer for this? And I know, Celuia, that this is your first class, so you might be swinging around. No problem, because if you watch the previous videos, you're going to be understanding what I'm talking about. There are videos which I shared with you. And then you can be able to ask the questions. I'm still around, so don't fear to ask questions. Now, what is the answer here?
3.5172.
Sorry?
3.5172.
3.5172. Mimi hiyo sio mimi nimesema, ndio umesema. Now, the other one is, what about the other one? Zero point what? What is our NPV now? What is our NPV? Celuia, will you be able to understand where this came from? Email or umepata hii? Celuia?
Yes.
Very good. What is the answer now? What is our NPV? What is our NPV?
Negative 26,942.
Very good. Negative 26.
942.
942. Negative 26,942. I want us to look at most probable case. We do the same. Right. What is the second one? We just need to look on the cash flows. The cash flows are 30,000 annuity. Multiplied by the present value interest factor annuity, 13%, 5 years. Right? Plus what? What is the terminal cash flow? In this case, I can see we have the terminal cash flow of 20,000. Multiplied by P5, 13%, 5 years. Minus 100,000. How much are you getting there? Because we are using the same discount factors, now you should be multiplying directly. Nothing different then. Then let me look on the last one, which is the best case. The best case, the cash flows are 40,000. Multiplied by PFIFA, 13%, 5 years. Plus now the terminal cash flow, in this case, we have 30,000. Multiplied by 0.5428 minus 100,000. Right. Meshach, what is the answer for the most probable case? What is the answer? Someone give me the answer, please.
16,372.
16,372, correct. And the last one? 16,372, that is the correct answer. Then the last one? What about the last one? Confirm whether you are getting something closer to this. 56,972.
56,972.
Remember, these are your NPVs. And the examiner requires you to get the expected NPV. You say, to get the expected NPV, you are going to be using the proportions provided for each case. For example, it should be negative 26,972, 942, sorry. We multiply by 0.2. It is the probability for the worst case down there. Then the second one, we have 16,372 times 0.60. The last one will be 56,972 times, this should be 8, 0.20. What is the expected? This is the requirement number 1. I will go straight to requirement number 3 before I come to requirement number 2. How much is this? Someone to show the answer? Someone to give me the answer, please. Unasema mwalimu afanye kazi yake.
15,829.2.
Come again.
15,829.2.
829. Sindio? But when you look on the requirement number 3, unaambiwa vizuri. Determine the project standard deviation of the net present value, right? Nakuja hapa nikukumbusha something you did when you are doing your O levels. Nilikuwa nasema to get the standard deviation, you used to take the summation of x minus x bar squared. You multiply by the probabilities. Now this will be our next topic. You'll be able to enjoy it so much. The portfolio analysis. Now, when you look at this, it is very simple to determine. Right now, we are not using the x's. What you have to be getting the standard deviation at your level. You say, I'm going to be taking the root of what? You take the summation of NPV minus expected NPV squared. You multiply by probabilities. You multiply by the probabilities. This is what is required at your level. Now, let us look at the NPV of the worst case. We start with the worst case. We say, let us take the NPV, which is negative 26,942 minus, right? What is the expected NPV of our project? It should be 15,829.2 squared. We multiply by the probability of 0.2. That is the first one. The most probable case here, it will be 16,372 minus our expected is 829.2 squared, 0.60. Then the last one, which we call it the best case, you're going to be saying 15,829. We subtract what? 0.2. No, it should be not like that. It should be 56,972 minus 15,829.2. All of these you square, then you multiply by 0.20. What is your answer here? So the first one should be negative 26,942 minus 15,829.2 squared. You multiply by 0.20. The answer here should be 365,000, not thousand, million, 875,110. Let me just round it off. 110. The other one will be 16,372 minus 15,829.2 squared. We multiply by 0.60. We are getting 176,779.10, right? Then the last one will be 56,972 minus 15,829.2 squared. We multiply by a probability of 0.20, getting 338 million. 545, 999, 998. What is your total there? Plus 176, 176, 779.10, plus 3658, 75, 110. Getting 704, 597, 888. So what is your standard deviation here? We say, let me take the root of your answer, which is 704, 597, 888. So what is your case here? So the root of answer, we are getting 26,000 for 544. 26,544. That is how you do the aspect of the standard deviation. Sorry? Hello? Are we together?
Yes.
Very good. Now, I want to get back to, because I know you're still writing, let me just continue here by doing the requirement 2. Talking about the sensitivity analysis, the sensitivity ratio computations, right? And because the examiner is asking us this question, is saying a sensitivity analysis of the salvage value if the variable changes from the base case value. The base case, it means the base case remain constant. What will be the effect of the worst in the base case? That is what the examiner is asking. So when you go to the worst case scenario, we treat it as a cost, right? The worst case is treated as a cost. We said when you have the cost to increase, you do what? When we have the worst case, what are we dealing with the salvage value? What are you going to be doing with the salvage value? The worst case scenario. What will we do? We talked about when you have the cost to increase, when you have the revenue, we reduce. But in this case, the examiner is asking us a sensitivity analysis of the salvage value, right? So in the worst case, can we be able to deal it with a worst case? We subtract. That is the worst. That is the worst case. So in this case, it means because we are dealing with the base case, the salvage value of 20,000. This is 20,000 now. It should be the 20,000 for the worst case. So it will be, when you take 100 minus 80, we get 20%. 20,000 of 20,000, 20% of 20,000, we are getting 4,000. That is how worse it can be. Are you together at that point? Hello? Are we together?
Yes.
So the worst of our project, of the cash flows, which we can be able to get, can only be going down up to 4,000, right? So once you get that, let us compute the NPV. The NPV of this. The NPV of this. So what am I going to do? I just need to take 4,000, replacing my 20,000 here. We multiply by the present value interest factor, which is 3.5174. Plus now the 5,000, we add 5,000 here. We multiply it with what? We say we multiply it with 0.5428 minus 100,000. How much are we getting there as NPV? How much are we getting there as NPV? This is wrong. Don't compute this. Because the examiner is asking us a very simple question. I have forgotten that point. Examiner anatuliza hivi. What is the sensitivity? We are analyzing the salvage value, right? We are analyzing the salvage value, not the cash flow. Very good. We are analyzing the salvage value here. Correct. That is correct. So in this case, if you analyze the salvage value, if you're analyzing our salvage value, taking into consideration watu wanaingia hapo wakirudi wanakimbia. Let me see them. Don't know where they are. You wameenda wapi? So it should not be this 20 because we are being told very well. There is something that I did not explain correctly. The question is asking the sensitivity analysis of the salvage value if the variable changes from the base. So you are going to be asking yourself, what will be the salvage value of this worst case scenario if you are going to advance it by 20%, right? And we are playing with a salvage value for the base. It is not this. It is 20,000 here. Where is it? This one. This is the one that we are playing with. The salvage value for the most probable. It is our base which we are using for analysis. So what will be the salvage value? And what is the computation of the NPV? So it means once you consider the sensitivity analysis of this salvage value, which now will be turning to 4,000, then we compute our new NPV. So how much will be the new NPV? We say, let us take 20,000, multiply by 3 point something, 5174, 5172, plus now 4,000, which is your new NPV. We multiply by 0.5428 minus 100,000, minus 100,000. That is how it should be, minus 100,000. Then for the best case scenario here, as you get that answer, what are we going to be using? We use 180% of 180% of the salvage value of the most probable, which is 20,000. This will be giving around that 6,000 shillings. That 6,000 shillings. That 6,000 shillings. So what is your new NPV? Unakuja kwa best case scenario. Unaniambia the best case scenario unachukua nini? For the best case scenario unachukua the cash flow yake, it is 40,000 if I'm not wrong. We multiply by 3.5172 plus that 6,000. We multiply it by 0.5172 minus 100K. Minus 100K. What is the answer for the first one? What is the answer for the second one? What is the answer for the first one? Someone please. Cecilia, ama kama sijamuona.
27, negative 27,488.
Negative?
27,488.
Negative 27,488. Correct. What about the other one? Nani hajatuongelesha leo? I have not heard from my gentleman here. Na mtu hajatuongelesha hapa. Tuongee tu. Sema answer yako hata kama ni ya uongo. Sema answer yako. How much are you getting?
59,307.2.
Sorry?
59,307.2.
070.
59,307.2.
and 7.2, right? So let us look
300.
at the
307.
nakosea kweli.
307.2.
Oh, 9307. Okay.
Mwalimu, question.
Yes.
Isn't the second one supposed to be 0.5428? Where is this 0.5172 coming from?
5428. Thank you. 5428. Correct that one. Correct that one, please. We're supposed to be getting 60,000. 229. Is something looking like that?
Yeah.
Correct. Now the percentage
Yes,
change
correct.
here, we are going to be having, we are going now to be taking our holds. These are our holds. So our hold will be 16,372 minus, now I'm doing for the worst case scenario, minus 27,488. We divided by what? 16,372 times 100%. Okay, this is the worst case. Then we have our best case here. It will be 16,372 minus 6229. You divide by 16,372. You multiply by 100%. Sasa nakuachia wewe utaenda ukajiexplainie. Hiyo utaenda ukaexplain now. You get the answers and then you explain. Already you have an explanation from the question which I did initially. Wacha nione kama naweza peana assignments. Sijui kama nishaiwapea assignments. But I have not sijakuwa attentive sana kuangalia on that. I will not be able to do that. Let me first do something here. There is something which I just want to do very quickly. Very quickly. Are we finished up writing? Are we done with writing? Yes. Let me know. Yes. Tumemaliza kuandika. You can comment there on our chat box. You can also unmute. Let us know whether you are finished writing. Are we done writing? What wamelala? Let me see.
Yeah, I'm done. I don't know about the rest.
Sorry?
I'm done writing personally.
Thank you.
Done.
So if we are done, I just want to share something here. One who is greeting, okay? Saying that we are done, Cecilia, okay. I just want to explain something small regarding to the scenario analysis. And we have been told that a scenario analysis is a wider case of sensitivity analysis. That is why we normally say it is just an improvement. When you look on the sensitivity analysis, it's just an when you look on the scenario, it's just an improvement of sensitivity analysis, which is normally make it more practical. Since a change in a decision variable is expected to affect other variables too. And that is what we are going to be. We are not going to be far from what we have been doing in regard to the scenario analysis. We have been told here, this will allow, analysis allows for a simultaneous change in the values of decision variables. Unlike sensitivity analysis, where only one variable changes at all time, the values of all other variables remain constant. This analysis allows for simultaneous change in the values of a decision variable, which is more realistic. Remember, when we were looking on the analysis which we have done in sensitivity analysis, there are small changes. There are small changes which we were able to do there. And then the other variables were remaining constant. When we are dealing with the scenario analysis, all the variables will be doing some changes, because we have to be looking on the following, because we are saying there are only three types of scenario analysis. There are only three. One, we normally have the best case scenario, and this is basically used by the most likely, or which we normally talk of the optimistic or risk takers. We normally have the case scenarios, which normally represent the risk neutral investors. Then we normally have the worst case scenario, which normally represent the risk averse investors. And these are the people who are normally called pessimistic. Then the NB, we normally compare the percentage change in the NPV from the best case to the best case scenarios with the percentage change in NPV from the best to worst case scenarios. And if this percentage changes from the best to the worst is higher than from the best to the worst, we have said from the best to the best is higher than from the best to the worst, the project is viable and less risky. There is a question which we did sometime there regarding to the percentage changes. And this question was done in November 2019. I was able to touch the aspect of sensitivity ratios, where we said to do the computation for the NPV, for the sensitivity ratio, we used to take the NPV of the project, we divide by the present value of the decision variables. It is in our previous video. So I just want to take from where we left, because it has some concepts for the scenario cases there. So you will not be able to blame me. For example, for Seluya, you will be there with us because we did it. And if you can be able to watch our first video, which has the sensitivity analysis, you will be able to see the concepts and how we did it. Right now, I just want to focus on that aspect of scenario analysis. Let me look on the question I share with you here on my screen. 2019, that is the area where we have to be looking at. 2019. I will request whether we will be able to manage time, because we have a lot to cover. We need people on time in class. Taking order to join. Where the question now should be very far. Okay, it is here. Remember, this is the question which we did last time, and we were able to check on the sensitivity of the project net present value. We did it, and we were able to understand as per my assumption. Now, when you look on part C, we have been told, part C of that question, we have been told, further analysis of the company in B above suggests that the sales volume could depend on the expected economic states as follows. When you look on the poor, normal, and goods, they have already provided you with the probabilities. But When you look on the annual sales volume, which are provided, for the poor will be 17.5 million. The normal will be remaining as per the requirement part 1. When you look on the part 1, we remained because they told us it is expected that the 20 million units of microchips will be sold. So that one will be remaining as how we did it in the first phase. Nothing is going to be changing there. What we are going to be calculating here should be the NPV of the NPV of the poor and goods, because we have the NPV for the normal. For the normal is around. So in this case, in order to get this question, allow me to use this information hub there, because we have been told, they have already told us this. To get the expected net present value of the project using the scenario analysis. Now, that is not the case. Allow me to read the part B, where we are being told, Sunny Technology Limited is considering investing 50 million in a new machine to manufacture computer microchips, which with an expected useful life of 5 years and no salvage value. It is expected that 20 million units of microchips will be sold each year at 3 shillings per unit. The variable production costs are expected to be 1.65 per unit, while incremental fixed cost will be 10 million per annum. Now, the cost of capital is already provided there. For those who are not in class, I said, if, for example, an examiner is giving a question, there is no tax, there is no tax, there is no tax. Don't put taxes in your computations. Don't apply taxes in your computations. That is what I said last time. Now, let me share my board here so that we can do this one. This one is not hard. So let me talk about continuation of November 2019, question number 1B. Correct. So what I just want to do here, I just calculate the NPV for poor and good here, because for the normal, we can recall. Now, let's start by looking on the contribution. Remember, here what is going to be changing from what we computed, it is the sales. It is the sales, which we are selling during the year. So in this case, the contribution per unit will be remaining, because one microchip, we are selling it at 3 shillings, but the variable cost is 1.65, right? Allow me to use my sales in thousands of shillings. So here we multiply by 17,500, right? 17,500. So how much am I getting here? So 3 minus 1.65, I multiply by 17,500. We are getting 23. Are we getting a good answer? How much are we getting here? 23,625, right? Then the other one for good, we are selling how many units? We are selling 22,500. So I take 3 minus 1.65. I multiply by 22,500. 22,500. You're going to be getting 30,375. Right. Then after we do that, let us list our fixed cost. For both cases, we have 10,000 shillings. So what is your earning before interest and taxes? So in this case, here we have 13,625. And here we have 23,775. Are we together to that point? Those are your annual net cash flows, because we don't have taxes. So this we assume is your annual net cash flows. That is your annual net cash flows. After you get this now, let us compute the NPV, because the examiner needs the expected. You just come here, you tell me, Mwalimu, we are doing for the NPV for, you have the NPV for all of them. So we start with the poor, we have goods, then we have our normal. So in this case, for poor, we have gotten 13,625. This is 20,375. And I remember you can be able to recall, sorry, you can see there is a challenge there for our network, please. Okay, buffering, there is a buffering there. Okay. So for the normal, we can be able to recall. How is our normal? We were able to get the NPV for normal around 17,000, I remember. Then remember that, Seluya, we are getting these, right? This is our annual net cash flows. And we are receiving these for almost, I think the project's useful life is 5 years. Let me check. Yes, we are getting 13,625 for 5 years. This is annuity concept. And we had already gotten that discount factor as 3.6048. Just need to copy it. 3.6048. We subtract what? What are we subtracting here? We're subtracting our initial outlay. As our previous question, we said it was 50,000. So whatever we are getting here is my NPV. So the first one will be 13,625 times 3.6048 minus 50,000, getting negative 884.6. The other one will be 20,375 times 3.6048 minus 50,000. We're getting 23,448. 23,448. Allow me to round off. And the other one would be 17,000 times 3.6048 minus 50,000. Getting 11,282. That's how you have gotten your NPV. Examiner is asking you for the expected. You just multiply with the probabilities here. Multiply with the probabilities. Now remember the probabilities were 0.3, 0.1, and 0.6. What is our expected NPV? What is the expected NPV? Let me start with the last one. We are getting 67.69. The other one here should be 2344.8. Then the first one is negative 884.6 multiplied by 0.3. We are getting negative 265.4. What is our total NPV expected? What is the total expected NPV there? What is our total expected NPV? Someone?
Eighty-eight, 48.4.
How much?
88, 48.4.
8848.4. 88.4. You know, hakuna mtu hajaelewa hiyo. That is not hard. Allow me to do the last thing of the night. The last thing, taking 20 minutes. I just want us to do something called certainty equivalent coefficient. It is another method. So the certainty equivalent coefficient. So allow me just to summarize it. It's a very simple thing, right? You normally say, when you're dealing with the certainty equivalent coefficient, it is normally called CEC. It's normally called CEC, right? And this technique normally eliminates the risk, right? You say the technique normally eliminates the risk from the cash flows. Normally eliminates the risk from the cash flows by multiplying the cash flows by multiplying the cash flows with certainty factor. By multiplying with the certainty factor, which we are calling the CEC, right? The certainty factor, which we are calling it the CEC. The risk-free cash flows are discounted using the risk-free rate of return. That is another point which you need to get here. You say the risk-free cash flows are then discounted, are normally discounted using the risk-free rate of return. The risk-free rate of return. So when you're computing the NPV, it doesn't have much difference, or it is of similar formats. We normally take the present value of the cash inflow minus our initial fee, minus the initial fee. So how do we normally compute the present value of the cash inflow? The present value of the cash inflow, we normally get it by taking what? We normally take the cash flows, we multiply by the CEC, then you multiply them by the present value interest factor. I don't know where you're seeing here. The present value interest factor, RF n years. RF n years, as you're seeing here. This is the risk-free rate of return. The risk-free rate of return. Now, what are we getting here? What is the meaning of all this? Once you multiply the two, we have said, you normally get something called the riskless cash flows. You're getting something called the riskless cash flow. The riskless cash flows. That is how you normally compute the aspect of this. I just want to do one question because we have only one for the period when the syllabus was changed. So allow me to do it very quickly. It doesn't have a lot of complexities. So this question was tested when? Let me check. Question was on August 2022, question 1A. August 2022, August 2022, August 2022. That is the last thing we have to do today. Oh, we are going to be in a very good position now. August 2022. Let us start here. So where the question, let me see, where are we? April, where are we? August 2022, very fast. Someone to read the question. It is already in your screen, please. Someone, please.
Question 1A. A project requires an initial investment of 500,000. It is expected to generate cash inflows of 200,000 annum for the next 5 years. Additional information. The firm is indifferent between a certain amount of 181,347 at the end of the first year and the expected amount of 200,000. The risk-free rate of return is 5% per annum required. The net present value of the project incorporating certainty equivalent coefficient to advise their management on whether the project is worthwhile.
Thank you. So we are being given only two elements there, which normally ascertain your question. So when you look at it, the additional number one is very crucial for your question. Why? Because that is how we normally get our CEC. That is how you get your CEC. So to get the CEC, we are going to be taking the certainty amount. We divide it by the expected cash flow.
Hiyo food imeiva.
Ikawa.
Tumeshiba. Now, the expected
What?
cash flow.
What a day is this? This is a very beautiful day. Situations of every situation.
Yeah, tusalimia leo. That's very good information there. Correct. Now let us continue. Sorry for that. So in this case, we have said the CEC, we normally take the certainty amount. We divide by the expected cash flows. How much is the expected amount? The certainty amount is for the additional information number 1. We are given 1 into 1,000. 1 into 1,000, 347. We divide it by a cash flow of 200,000. A cash flow of 200,000. So what is the discount factor you're getting? You're going to be getting 0.9067. And because you are dealing with different years, let us take our years. Do our compounding here. So we have here 1 to 5. What will be the discount factors for this year? Nasema nachukua 0.9067, you raised for 1. 0.9067, you raised for 2. 0.9067, you raised for 3. 0.9067, raised for 4. 0.9067, you raised for 5. How much are you getting here? Now, the first one will be 0.9067. Wacha ni raise yangu. Breakfast, 0.9067, you raised for 2. Getting 0.8221. We go to year 3. Getting 0.74. 0.7454. We go to the last one now. Get that one. Year 4 now. 0.67. 6759. Then we go to the last one, number 5. Getting 0.6128. 6128. 0.6128. Once you finish doing that, take your cash flows now for the respective years. Wacha nianze hapa swali. So the years, tuko na year 1, 2, 3, 4, and 5. I take my cash flows. In this case, each year, we are generating 200,000, 200,000, 200,000 each year. 200,000, the last one will be 200,000 there. After we do all this, after you do this, you multiply now with the riskless, with the CEC, sorry. So once we multiply with the CECs, niwezi umepata hapa, 0.9067. 0.8221, 0.7454, 0.6759, 0.6128. Whatever you're going to be getting it is normally called riskless cash flows. Riskless cash flows. I take the first one, which is 200,000, multiplied by 0.9067, getting 1 into 1,340. The second one will be 200,000. We multiply it with 0.8221, getting 164. 164 for 20. 200,000 we multiply by 0.7454, getting 149. 189,080. 200,000 we multiply by 0.6759. 135. 180. And the last one will be 200,000 to multiply by 0.6128. You're getting 122. 560. You have said once you do the riskless free cash flows, the riskless cash flow, sorry, you're going to be multiplying it with the present value interest factor at the rate of how much? At the rate of 5%. That is the risk-free rate of return. Then you're going to be getting your present value at the end. So in this case, the first one will be hii tunatumia ile formula ya 1 plus 1, 1 plus r raised for negative n. So the first one will be 1.05 We raise power -1, getting 0.9524. We have the second one, getting 0.9070. The next one is 0.86, 0.8638. The other one will be a 4, getting 0.8227. The last one itakuwa ngapi? Ya 5. 0.7. This should be 35 there. Multiply with your riskless cash flows. Multiply with your riskless cash flows. So 181,340. Multiply by 0.9524. Here we are getting 172. 172,708. The other one will be 164,420. Multiply it with 0.9070, getting 149. 129, 0.8638. We multiply it with 149,080, getting 128. 775, 135,180. We multiply by 0.8227. We are getting 111, 213. Then the last one will be 122, 560 times 0.7835, getting 96,026. How much it is? Plus 111, 213, plus 128, 775, plus 149, 129, plus 172, 708. We get 657, 851. Then you list your initial outlay. How much is our initial outlay from the question? Our initial outlay is around 500,000. What is your NPV here? You say my NPV is 157,851. Advise the investor. Someone to give me the advice? What is the advice now? What?
Investment is worth.
Sorry? What is the advice?
The investment is high since the net present value is positive.
Thank you so much. You say the investment is worthwhile since our NPV is positive. That is a correct advice. Now, allow me to stop at that point. Tomorrow we are doing 3 things which are very key. We are going to be doing the decision tree. We are also going to be doing aspects regarding to inflation, where we are going to be incorporating the risk and uncertainty. What else are we going to be checking tomorrow? We have to be checking on the capital rationing. We have some few questions we have to factor there. And if time will be able to allow us, we do the investment decisions under risk and uncertainty. That is what I was talking about. And also we need to be doing the investment decisions under inflation. If we can be able to arrive to class on time, then those are the things that we need to discuss tomorrow. Let us stop at that point in case, unless there is a question.